Welcome back to the Deep Dive. Our mission today is pretty straightforward. We're cutting through all the noise to identify some high-quality businesses.
The ones that are genuinely study-worthy for the next cycle.
Exactly. We're looking across, more than 15 sectors, and we're zeroing in on companies that combine strong recent results with, real future visibility.
Things like credible growth pipelines, solid expansion plans, and, crucially, a comfortable entry valuation.
That's the goal. The idea isn't to give you tips, but really to equip you, the learner, with a focused list for your own due diligence.
Right, before that next results season really kicks into high gear, we're focused purely on the business fundamentals and, the quality of management execution.
And we have to say this, it's our crucial disclaimer. This deep dive is based entirely on the source material we've gathered. It is strictly for educational purposes.
And it is absolutely not investment advice, not a recommendation to buy or sell anything. We analyze the execution, you do the investing.
So if you find value in this kind of analysis and want that quick, insightful knowledge delivered right to you,
Please take a moment right now to like, share, and subscribe. And definitely hit that bell icon so you get notified the second our next deep dive is ready.
Okay, let's unpack this. I think we should start with the big picture because the sources are all suggesting a major rotation is finally underway.
Specifically back into financials.
Yes.
And what's fascinating here is, just the sheer underperformance of the sector. For the last, 2 or 3 years, the entire banking and NBFC space.
Non-banking financial companies, for our listeners.
Right. That whole space has been largely ignored by capital. Even when many of the players were executing their strategies, flawlessly.
It was the great ignored trade. It felt like the market just had plenty of other shiny objects to chase.
Precisely. But now the macro tailwinds are really substantial. We're seeing this sustained shift toward double-digit credit growth.
Inflation is easing too.
Inflation is easing, policy action is helping, and crucially, there's a general recovery in that microfinance segment. This just means the financial space is, it's abundant with opportunities and can't be overlooked anymore.
You brought up a really critical nuance before about the interest rate cuts. We've seen them, or at least we're anticipating them, but the benefit might not flow through to the bottom line right away.
Yeah, this is a really key timing point. It's all about the net interest margin, or NIM. When the central bank cuts rates, a competitive bank has to pass that benefit on to the borrower, immediately.
So your loan rate drops quickly.
Instantly. But the bank can't just cut the rate it pays to its depositors overnight. Those older, higher rate deposits, they take time to mature, maybe 6 to 12 months.
So the bank's cost of funds stays high for a while, even as its lending income drops.
Exactly. And that's what causes that NIM expansion, of profit spread widening, to be delayed by maybe 1 or 2 quarters. It's an industry-wide thing.
Which brings us to the most important part, selection. If we know this timing issue exists, how do we separate the quality from just cheap stocks?
You have to be highly selective. Just chasing a cheap price-to-book valuation is so dangerous. The focus has to be on lenders with demonstrably clean asset quality, low bad loans, and management teams who have proven they can execute.
Otherwise, you just end up in a value trap.
A classic value trap. The stock is cheap for a very, very good reason.
Okay, let's start the sector analysis then. Let's do banks. Now, the large private players like an ICICI or Axis, they're stable, but their valuations are quite premium.
Around 3x price to book, and growth is fine, solid but moderate.
Right, so the real opportunity, it seems, is where we can find that execution leverage, and that's often in the mid and small cap space.
That's the consensus from the sources, yeah. If we look at, say, mid-sized turnarounds, IDFC First Bank comes up as a top pick.
Their microfinance issues are behind them now.
It seems so. The sources suggest those challenges are firmly in the rearview mirror, and Q2 was key. It was the first time in, I think, 6 or 7 quarters that we saw genuine quarter-on-quarter profit growth.
And that was driven by lower provisions.
Lower provisions and credit costs, just a clean result. But their real story is built on something called operating leverage.
Okay, break that down for our listeners. What does that actually mean for a bank like IDFC First?
It's maybe the most powerful story in the sources. Operating leverage just means their revenue growth rate is about to start dramatically outpacing their cost growth rate.
Because they've already spent the money.
They spent aggressively on IT, on branding, on opening a huge number of new branches. That massive investment phase is now mostly done. So they're anticipating significant operating leverage, probably starting strongly in FY27.
Their fixed costs flatten out, but the revenue from that bigger footprint just takes off.
Exactly. And that's why their current PB of around 1.3 to 1.4 times looks very attractive to some.
Okay, moving down in size to small cap specialists, DCB Bank is noted for stability.
Right, they have very minimal exposure to that riskier microfinance segment. And despite delivering pretty solid loan growth, 18 to 20%.
They trade near book value, which is one of the lowest PE ratios in the private banking space.
It suggests a lot of comfort if that execution just stays stable. Now, a different case, more medium to long term, is CSB Bank. This one requires patience.
Why is that?
It's a highly secured book. It's heavily backed by gold loans, up to 45% of their lending. They focus on MSMEs and businesses, which means, lower yields than an NBFC, but much superior, lower risk customer quality.
And like IDFC, first, they've been in a heavy investment phase.
Textbook case. They've invested heavily in expansion. The reward that operating leverage is expected in the back half of FY27. Delayed gratification story.
And quickly on small finance banks, the SFBs.
Ujjivan and Equitas are the top contenders here. Ujjivan looks particularly compelling. The market just doesn't seem to have fully priced in the strong earnings expected in Q3 and Q4.
So it has a low forward PB of what, 1.2, 1.3x?
Around there. But this is where we see that asset quality lesson again. The sources are very cautious on players like Utkarsh and Bandhan.
Even though they're trading below book value.
Doesn't matter. The conviction is low because of continued poor asset quality. You really need to see a proven multi-quarter cleanup before you can get comfortable. You just can't compromise on asset quality in lending, period.
So to summarize banking, IDFC first really stands out as the overall conviction pick there. Mid-sized and moving from that investment phase into a profit harvesting phase.
That's a good way to put it.
Okay, let's turn our attention to the MBFCs, the specialized lenders. We're looking away from the big, highly valued generalists.
Like a Bajaj Finance. Instead, the focus is on players with structural advantages.
And that advantage often comes from strong group backing, which gives them a lower cost of borrowing.
Exactly. A low cup is a massive competitive advantage. Geo Financials is a prime example. The parent backing keeps their COP low, around 7%, and their loan book is scaling up fast.
And the other businesses are starting to fire up.
The ancillary businesses, asset management, wealth, broking, they're finally moving into that critical execution phase now.
Pyramidal Finance is another one with strong parentage.
Right, that provides a safety net. They're pushing very aggressively into the retail loan book and using AI for better underwriting. With a low PB of 1.2 to 1.3x, the potential for a re-rating is high.
Especially if they hit that target of tripling their profit in the next 2 years.
It's an ambitious target, but the path is there. But if we had to pick, the best high-growth NBFC, the sources point very strongly toward Capri Global.
Why them specifically?
Their high growth, which is 35 to 40%, is underpinned by 3 different structural levers.
Okay.
First, they're increasing yields by focusing on products like gold loans. Second, they're lowering their CABI as their credit rating improves. And third, OpEx efficiency now that their branch expansion is stabilizing.
So they're growing fast while maintaining stable asset quality. That's the holy grail.
It really is. Now, in MSME financing, SBFC is a key one to study. Management has been very clear that higher credit costs are the new normal.
And they're just adapting to that reality.
Proactively, they're adjusting their whole model to maintain healthy return ratios despite this, still targeting 25-30% loan growth. Five Star Finance, meanwhile, is on the close watch list.
Q3 is expected to be the bottom for their asset quality issues.
That's the expectation. If that happens, it sets them up for potential high growth from Q4 onwards. It's an execution check candidate.
And for pure microfinance,
Muthoot Microfin and Arman Financial are the preferred bets. Both are trading pretty attractively, near or even below 2x PB, with clearly improving profitability.
okay, let's pivot to housing finance. This sector was a market darling for years, but now capital is rotating out. What happened?
It was a classic TNA environment. There is no alternative.
Right.
When banks and other NBFCs were struggling with bad assets, HFCs were the safe haven. Secured loans, high growth, easy profits. But now, 10 is gone.
because the banks and NBFCs are back in the game.
They've cleaned up their balance sheets, and now they offer competitive growth at better valuations. It just makes the HFCs look, comparatively overvalued.
And that increased competition had real consequences, didn't it?
Huge consequences. The big commercial banks push heavily into the prime loan segment. This forced the large HFCs like LIC housing into affordable
A
housing.
much more competitive space.
Much more. It compressed margins and led to higher balance transfers out BT out. Basically, higher customer turn as people jumped to better rates from the banks.
But inside that pressure cooker, India Shelter is noted as a resilient model. How are they insulated from this?
They found a perfect defensible niche. India Shelter operates mainly in Tier 3 and 4 cities, and they focus on self-employed customers in the daily essentials economy.
So like vegetable vendors, small shop owners.
Exactly. That client base is stable, reliable, and just fundamentally less attractive to the big commercial banks. So India Shelter can maintain a high yield, around 14%, and a consistent spread of 6%, despite all the industry turmoil.
That defensibility is what gives them the re-rating potential.
That's the argument, yes.
Okay, let's move on to fintech and market infrastructure. Starting with the platforms, Jagal Prepaid is a proven high-growth model.
Consistently delivering 40 to 45% growth. But this is where the analysis gets really interesting. They have a new major trigger in the pipeline.
The RuPay credit card.
The launch of the RuPay credit card business is a game changer. It's forecast to generate significant new revenue, maybe $500 crore, with very healthy margins. It just shows the power of a platform model.
Leveraging an existing user base to roll out a new high-margin product.
Precisely. On the other hand, a company like Emerald Finance is flagged for needing more execution visibility.
What's the issue there?
Well, asset quality issues are starting to emerge, and it feels like management is still trying to find a truly scalable, repeatable model that doesn't need constant, expensive changes. That uncertainty keeps conviction low.
Yeah, what about broking and wealth management?
Jill 1 is on the watch list. Their margins are expanding, tracking towards a 40–45% EBITDA target. Then you have the high flyer, Grow, trading at a huge premium.
A PE of around 50x. Is that really justifiable?
It is, but only if they execute. The high valuation is sticky because of two things. One, their massive market share gains, and two, that powerful operating leverage potential again.
They have millions of users.
Exactly. And now they're rolling out all these new high-margin products, commodities, MTF, wealth management, to that huge user base with very little increase in operating cost. That's the definition of profit acceleration.
And for pure wealth management, Novama Wealth is the best fundamental play.
That's what the sources suggest. Their overall growth might look slower, say 10–15%, because their capital markets business is cyclical. But the core wealth management segment is consistently hitting 20–25% growth.
Which shows that sustainable return ratios are the key driver, not just the fastest top-line growth.
Right. And on the infrastructure side, CDSL, CAMS, KF, and Tech, it's a great long-term story driven by financialization. But the entry valuation is just extremely high.
When CDSL is trading at 70x PE.
Yeah, it feels prudent to wait for either a price correction or for some truly spectacular earnings acceleration to justify that kind of premium.
Okay, let's spend a moment on the other standout sectors because they illustrate some really crucial non-financial frameworks. Let's start with EMS, electronics manufacturing.
Keynes has seen a severe valuation derating. It dropped from, 150x PE all the way down to 70–80x.
So that derating, plus their strong execution track record, presents an opportunity.
A classic opportunity. The key check here, though, is working capital normalization. How fast are they converting sales into actual cash? If that normalizes in the second half like they've guided, the opportunity is very clear. Surma is also a strong play there.
Okay, in FMCG, Manorama Industries stands out. High growth, 40–45%, but also superior self-sustainable return ratios. Why does that self-sustainability matter so much?
Because it means they're incredibly efficient at generating profits from the capital they employ. High ROE, high ROCE. This separates them from peers who might also have high growth, but need to constantly raise external capital to fund it because their own return ratios are weaker.
Manorama's profitability protects them.
It shields them. Finally, let's look at retail. V2 retail is expanding aggressively using QIP funds.
And the sources justify this because the new stores are profitable from day one.
Highly profitable, high sales per square foot, and they achieve break even in the very first month. That's just superb execution.
In contrast that with retail jewelry, using PN Gadgil as an example.
Right. Here you see the importance of checking non-obvious metrics. The top-line sales growth is fine, but the real health of the business depends on tracking that break-even period for new stores, which is much longer, 18-24 months, and how they manage working capital outside their home market.
If they fail there, the cash outflow just increases and weakens the fundamentals, even if the sales number looks good.
Exactly. That high sales number suddenly becomes hollow.
So, after all that, what does this deep dive tell us? Let's try and summarize the key learnings and frameworks for finding a truly study-worthy business.
Okay, framework one has to be asset quality first, especially in lending. I mean, never, ever get excited by a cheap valuation if the asset quality is getting worse.
That was the clear lesson from the small finance banks.
Absolutely. Framework two, execution over commentary. Management guidance has to be backed up by clear execution. You need to see the results.
Whether it's the cost structure at CSB or the asset quality turnaround at 5-star.
Right. And framework three, hunt for operating leverage. Look for those businesses that have already gone through the pain of heavy investment and are now set for high profit growth without a big jump in costs.
IDFC First, CSB, Capri Global, Grow. All great examples of that.
And the last one, framework four, the danger of a single metric. High sales growth by itself is just not enough. You have to study the consistency, the sustainability of profit.
And those critical metrics like working capital in manufacturing or new store profitability in retail.
Yes. So to summarize the big themes, we're seeing this clear resurgence of select mid-cap financial players like IDFC First and Capri. We're seeing the strength of platform businesses like Jagal and Grow, and the superior performance of companies in those defensible niches like India Shelter and Manorama.
So we really encourage you to take this curated list, do your own detailed due diligence, and apply these frameworks to find the next quality compounder.
And our final provocative thought for you to think about. In this new cycle of capital rotation, are you more protected by the business with the highest top-line growth or the one with the strongest profitability protection? The one that can turn EBITDA into cash flow, even if its growth is a bit lower for a while.
Something to think about. If you think this deep dive added clarity and value to your market understanding, please take one more moment to like, share, and subscribe.
And make sure you click that bell icon. You will not want to miss our upcoming look at the hotel and travel sectors.
Thank you for joining us.